Welcome, folks. This is Tom O'Brien of TFNN. We go 5 days a week. We go 10 hours a day. We go 24 hours a day on the internet at TFNN.com. Always remember, folks, whatever you think about, you bring about. Whatever you focus on grows. Hope everyone's having a great day, safe day. Let's make it a great night, folks. Always do your best. Surrender and let go of the past. Whatever life takes away from you, let it go. When you surrender and let go of the past, you'll have yourself fully alive in the moment. Letting go of the past means that you can enjoy the dream that is happening right here, right now. Yesterday's gone. Tomorrow's not here. What are you doing right now? Market-wise, let's take a look at it out here. We have the Dow Industrials up 82, NASDAQ up 30, S&P's down 13, gold contract up $1.60, trading at $12.53 an ounce. Silver, flat, $14.70 an ounce. Light sweet crude, that was toasted, folks. And we're going to have the API numbers out at 4:30 this afternoon. Oil down $3.65, $46.24 a barrel. You came down with wide price spread, accelerated volume. Bottom line, oil wants to get down into this $45 to $42 area. Gasoline, unleaded gasoline, is trading out at $1.37. That baby looks like it wants to get down to somewhere in the dollar area. So driving up to the pump, folks, we are going to have inexpensive fuel. Notes and bonds continue to want higher price. If we go take a look at them, you get the 10-year note right now up 6 ticks, trading 120.27. 30-year bond up 22 at 143.29. We get over and take a look at that 10-year note first. What you have with the 10-year note is that we did 1.5 million contracts out here today. You closed at the highs. We have the Fed meeting right as we're speaking right now. They're going to come out with a statement tomorrow at 2 p.m. Bottom line, they want higher price. Right now, the yield, we're at the low end yield of the last 6 months. We're at 2.82. If we take a look at the year, you're right in the middle. We are a half a percentage point off the 10-year. And that's a big number, folks. Bottom line, 2.825. That's where we're standing. If we go over and take a look at the 20-year plus TLT, what you have here, let me just see if we got an ABC up. Yeah, we did. They got the volume into it. So this is going to be pretty cool. So the TLT is the 20-year plus ETF structure. What 20-year plus means is that you get a 30-year bond, but there's 20 years left on it before that they get the coupons off it. That's what you have. This took out the B point, took it out with volume. Now this is saying this is pretty cool, man, because your ABC structure here is going to bring you up past the 123 area. And the 123 area, just so you can get a heads up on this, we haven't been there for a long period of time. Last time we were at 123 goes back to January of the beginning of this year. And that's saying also that you're going to have higher prices in the bond market, lower yield in the bond market. The 30-year up 21 ticks, 143.28. We get over and we take a look at that 30-year. What you're going to see with the 30-year. 30-year also had volume, pretty cool. 300,000 contracts, 303,000 contracts as we're going into the highs. This is going to be a big day tomorrow, folks. 2 o'clock tomorrow, that volatility is going to be here in spades. If we take a look at the Fed Fund future rate, now this is so unusual, it's unbelievable. The Fed Fund future rate of a 25 basis point hike, which is a 1/4%, is 64%. I've never seen that, folks. Well, I've seen it, but not when the market has been predicting for a long period of time that there's a 100% rate hike tomorrow of 25 basis points, as well as if now watch this. This is really cool. If we go back 6 weeks, what would end up happening is that the marketplace was saying, as well as the analysts were saying, that we're going to have 3 rate hikes in 2019. Well, guess what? We're not over 28.4% that there's going to be 1 rate hike. Never mind 3. That's where, and what the Fed Fund futures are, just so you can wrap your head around this, that's where people are trading off of where the Fed rates are going to be. And right now, the effective rate, we're at 2 to 2.25. The effective rate is actually 2.2. And you've got to remember something. What the Fed fund rate is that what the banks can borrow off the Fed or bank to bank overnight. And they do it bank to bank overnight for repos, okay? Bottom line, does it make a difference? It absolutely makes a difference, because what happens is that the theory is that where the Fed fund rate is, that's going to push the 2-year, the 5-year, the 10-year. What has happened, however, is that as the Fed has kept saying that they're going to keep raising rates, the marketplace, the last 6 months, have been buying notes, they've been buying bonds. They're saying, market-wise, they're saying that I will take the 2.8%, or maybe I'll take the 3%, because I think that's a good deal. Well, you know, if we look at the marketplace here, it's not only a good deal, it's an outstanding deal, because when you look at the indices, you have the Dow Industrials down 4.3% for the year, S&P's down 4.7, NASDAQ down 1.8, and then on top of that, if you did buy, so watch how this works, if you turned around and you did buy the 10-year note, TY, let's just do the 10-year so you can see how this works both ways. What you're going to see, TY, you're going to see if we go back, let's just say go back 2 months, you bought the 10-year at 117. Okay, so you're paying basically $1,117 for a $1,000 note. Well, now that's worth $1,120. Well, no, $1,200. That's what it's worth. And bottom line, so that's, you know, the aspect of the bond market, folks. They're making money, and I suspect that the way that bond market is trading right now, it looks like whether the Fed goes up tomorrow 25 basis points or not, it looks like their statement's going to be dovish. So you're going to see notes go up, bonds go up, gold go up. Dollar should pull back. If that's the case, and we're going to get bearish, a dovish rather, that'll pull back. Statistically, what we have here, which is going to be really unusual, since 1981, the Federal Reserve has only raised short-term rates twice in the 76 times that they've raised them, when the S&P has been down on the 3-month basis, 6-month basis, and yearly basis. And that's exactly what we have. So if they do raise them, this is going to be the first time that they raised them since 1994, because that's the last time that happened. And that happened because they felt that inflation was running away from them. So 2 o'clock tomorrow, big number. Stay right there, folks. Come right back. We're going to have those oil numbers for you. It's at 4:30.